Good afternoon, ladies and gentlemen, and thank you for staying for the best bits. We have three of the most interesting people to talk with this afternoon, but I do want to make sure that you get to do some of the talking. We want to talk about the Middle East and the Asian investors coming into Europe, and I think it's very important. I'm not going to spend time putting it all into context. You've heard how much investment is coming out of the region. It's really your session, and if we don't get some of the questions coming out of the floor this afternoon, then I'm going to be worried that you're going to be fast asleep. So before we start, can I just have a show of hands, and if the lights can go up, it will be even better. How many investors in hotels do we have actually in the room? Who's an investor here? Lovely, lots and lots of hands. Now keep those hands up if you're from the Middle East or from the Pan-Pacific Asian region. Okay, so if these guys get into trouble, then we'll look to you for some answers. So, question number one, gentlemen. We have, as you know, Christopher Knable, Mike Goodson, and Derek Chung. They are going to tell you everything you want to know. So make sure that you get the questions out that you want. But I'm going to get them to talk a little bit so that you understand a little bit more about what they do. Gentlemen, I want you to talk through no more than 1 to 2 minutes, okay? Now, that's not the sort of 1 to 2 minutes that this whole session has gone on before, but really a 1 to 2 minute. Tell us about a recent deal that is typical of the type of investment that your company likes to make. Why don't we start with you, Chris?
Thank you. Well, I can't say that there's a typical deal, but for the assets that we tend to favor, we're looking for great assets that have a great location, a great story, a bit of history, great building, and have certainly some upside after we've spent some time to inject some capex and whatnot. So over the past year, we did a portfolio play with Intercontinental. So we're very happy with the hotels that we have there with the Carlton and Cannes and the Amstel. And we have great plans for those hotels. But typically it's single asset transactions, gateway cities, great story, great upside.
Okay, relatively similar to you, Derek, I don't think.
I have to say that, in terms of the asset type, we are not specifically located to, downtown. We are flexible in terms of location. But the more important thing is we need to have a, mature operation that offer high yield. Or stable high yield, because we are REIT, right? We are yield driven, so we have to look for yield. And in general, from the current situation, is in the sense that Asia, we don't get the kind of yield that we can get from Europe. As a result, we are actually looking at Europe. That's the reason. So,
what's your typical deal that you've been doing in China? I mean, you're big in China, and you want to be big in Europe.
We want to be big in Europe. Right now in China, I have to say that typically, if you look at the hotel asset, right now in general, you can only get maybe, in city downtown, maybe 3% yield. So that is actually very low compared to what we can get from Europe. And that is one of the reasons why we are seeing more and more Asian investors coming to Europe looking for, asset to acquire.
Okay, Mike, how do you differ or not from these two gentlemen?
I think that probably. I wouldn't say there's not a typical deal for us either. I think it's important to recognize that what we do is we are global investors. I think we like to think of ourselves as relative value investors. So we invest up and down the chain scale and then also across the capital stack. So we've done a mix of upper upscale and luxury investments. We've also done limited service investments. But at the same time, we've done everything from mezzanine pref equity to the outright common equity. I think the most recent one that I would use is fairly typical of what we do is the transaction with Marriott, where we forward acquired the 3 Edition hotels that were in development. So it combines our willingness to take on some development exposure, although that one was a little bit different, with a desire to be in key gateway markets in the upper upscale segment. So we've completed on 2 of those now. With London's been open, I think, over a year. Miami opened in November, December, and New York's due to open in the next 3 or 4 months. So.
Just as a matter of interest, I know you can't because you only do leases, but could you do a development deal? Would you do a development deal?
You know, it's something we've considered, and probably for the right deal, we might consider it. But you know, our favor really is towards existing assets, cash flowing. You know, that we can exert a little energy and capital and unlock that value. But you know, for the right deal, I mean, obviously in gateway cities which we like, it's harder and harder to find those good deals. So, you know, we have on occasion looked at something where we would do like a takeout deal, you know, turnkey on delivery sort of thing. You haven't done one yet, but something that we're probably open to.
What's the one key thing that each of you looks for when you're approaching a deal in Europe as opposed to anywhere else in the world? What is the single factor that you'll be focused on? Why don't you tell us, Derek?
Cash flow, mature operation.
Okay, so you choose one of those. You have to choose something else.
I would call it sustainable value. We're not looking to just get into some cyclical play. We're looking at sustainable value because we are long-term investors. I mean, we do sell, as people know in this room that follow the industry. We will sell if the time is right and the bid is right. But typically, we go into things looking to hold for the long term.
Mm-hmm.
So.
Chris?
Well, similar to Mike, we're also long-term holders of hotels. Selling really isn't in our vocabulary, so we do take a long-term view, you know, appreciation of the asset, long-term stabilized yield, two things that we look for.
Okay. I'm going to look out to the audience because you've really not had a chance to play this afternoon. And you know, I'm very keen that if you have a burning question, that we should have the opportunity to put that to our three distinguished gentlemen. If you have a question, raise your hand. There are some people with microphones, and we'd be very happy to hear from you. So, and if I fail to see you, and I'm sort of looking out like this, sort of stand up, wave your arms, and do whatever you can to get my attention. The lights are pretty low from where we're sitting. So if anybody has a question, if anybody doesn't, I'll move on. Guys, what do you think about asset prices at the moment? There's word on the street that says that prices are getting high, they're getting too high, that values are starting to run away with themselves. Of course, I wouldn't have a view on that. But where do you think, Mike, the price-value relationship is at the moment?
Well, I think it's certainly it's more challenging to find, you know, an obvious clear buy today than it was 2 or 3 years ago. I think there's a lot of capital flows that if you were in the earlier session you saw. There's a lot of money flowing into Europe. I think with it remains to be seen what the QE measures that the central bank is implementing will do to asset prices. But you know, there's just more capital availability. Financing remains pretty easily available, and so you know it's put upward pressure on prices. Makes it harder to find those obvious opportunities. I mean, having said that, when you are a long-term investor, and if you can find the right opportunity that you think will sustain value through a cycle and through multiple cycles, you can still get to where you'd be comfortable making an investment even in the current market. So.
How do you feel about pricing? I mean, I think it's fair to say that some of your compatriots have been at least pushing the envelope on pricing, if not in Europe, then certainly in New York. But how do you feel?
If we look at the real estate cycle between Asia and the Western world, I have to, you know, look at the past few decades. In general, the cycles are, you know, surprisingly, it's just opposite. I would say that, you know, right now we are looking at Asian, you know, asset valuation. Real estate asset valuation is at a relatively high level, and Europe and US are at a relatively low level. This is the reason why, from Asian perspective, you know, this is the way to go. I would say going forward if we want to grow, and you know, I would say that, you know, given that, you know, in general, you know, people are looking at, you know, you can see a lot of investment from Asia, you know, as you mentioned earlier, you know, about many mainland Chinese companies are coming to Asia, and also in general, I would say that, you know, the fund for a lot of state-owned enterprises in China, in particular, you know, for them to get the funding to buy overseas assets is actually not difficult at all. So, and then, you know, you can see that, you know, the valuation, you know, being pushed to the envelope. I would say that in US and Europe, partly because of the fact that the cost of funding is actually very cheap for many of these state-owned enterprise. And that is the reason why, for us, as a private enterprise, in order to compete with them, it's actually not easy, to buy assets. And that is also one of the reasons why, what is also the driving force for the price to go up, driven by the mainland Chinese companies as well.
So are you finding it difficult to compete with the Chinese, Chris, when you're looking to buy stuff? Are you finding that they've pushed the envelope too far for you?
Certainly, they can swing a market with the type of capital they're deploying and the manner they're deploying it. I don't know that we view it as a competition. I mean, everybody has their own strategy, their own perspective. In terms of whether we believe that the market is overpriced, I think it really depends on your appetite for risk and your investment horizon. So as Mike alluded to earlier, I mean, we're a generational investor. So, for us, the per key price maybe is not as important in the near term as it is, going forward. And I think there's been plenty of opportunities. I think we were talking earlier, and you mentioned you remember when you had to take a deep breath because we remember when London first had a per key valuation over £1 million. Well, if we could find a deal like that today, I mean, that would be a slam dunk.
That was 1998.
Yes, going back a few years. So, I think there are high yields to be had in Europe. They're probably not in the typical mature gateway cities, but again, it depends on your risk profile. But for a long-term investor, the gateway cities are still the place to be.
So are there any areas of Europe that you feel are probably no-go areas at the moment? They're not showing good prospects and so forth. Are you avoiding certain parts of Europe?
I don't know if avoiding is the right word. I think we have a different sort of perspective because, we have fewer hotels. So, you have a great number of hotels. Of course, you have a great number of hotels in China. For us right now, we have about 30 assets either operating or under development, and, our short-term goal is for 60. So for us, we sort of take a very measured view of things, and we can sort of pick and choose. We don't typically do portfolio plays. The Intercon deal was a bit of a unique situation for us.
It was more a portfolio of individual hotels.
Yes, exactly. And each of the hotels has a great story, which we like a great deal. Great location, great architecture in many cases, and tremendous value to be unlocked there.
But would you go to, in the same way that you've bought extensively in the UK, Mike, would you go to some of the more let's call them potentially volatile countries, whether it's Greece or Eastern Europe and so forth?
I mean, look, nothing is off limits, but we want to make sure that one of the things that we look at in investments that we enter into is that they're not easy to replicate. So, one thing about some parts of the world is that supply constraints are still pretty low, and so those markets where supply constraints are low, we would probably steer clear of, I think. If you look at some of the portfolio transactions we've entered into, those would be hard to replicate. If you look at, say, our UK acquisition from RBS, I think we bought that very well, and it would be very difficult to replicate something like that again. Greece, that's an interesting question. We get a few calls about opportunities in Greece. We even get calls from people that want to develop in Greece. We've not really engaged on one of those.
In the words
recently.
of Yes Minister, that's probably courageous.
I think Eastern Europe we're not terribly active in. In fact, we don't see a lot of opportunity. We have not seen a lot of opportunities in Eastern Europe.
Derek, how open are you to taking the more adventurous routes of some of these lesser-known parts of Europe from an international investor such as yourself?
I would say that we are new to Europe, so basically we would take a more conservative approach, I would say, as a start. But longer term, I don't rule this out.
So you'll ride on these guys' coattails to start with, and then find your own way.
Of course, yeah. Even in Asia, we are looking at opportunities. We are also take a conservative approach as well.
Okay. Ladies and gentlemen of the audience, I'm looking to you for some inspiration. I've almost run out of questions. Perish the thought, I haven't really, but I just thought I'd give you the opportunity to come up with your question. if you're interested in some of their money, now would be a particular chance to pitch to them if that was your interest and that was your opportunity. So if you need the microphone, just give us a shout. Put your hand up and we'll take it from there. Otherwise, I'm going to move on, and move on I will. Obviously, they're so comfortable. Well, nobody has a deal. I'm really rather surprised. What can I say? The branding aspect of hotels is an interesting area that I'd just like to go into. There's been all sorts of discussions going on about branding, and we're going to get into OTAs and things like that. And you know, the value of a brand and the value that a brand brings to an investment, I think, is certainly something that's coming up for discussion increasingly at events like this. Where do you feel that the hotel industry that you're interested in has got to as far as brands? How focused are you on brands? Could you ever envisage yourself doing anything that was, let's say, less than branded?
For me, it's not an important factor. I would say it's all about cash flow versus valuation. If you know, even if the hotel is not, you know, let's say it's 3-star, there's a value. So as long as they can generate the yield that we look for, I'm okay with that.
So you're okay, anything branded or not, doesn't matter?
It is not the most important factor from my perspective. For
Okay.
me, yeah.
How about you?
No, our bias would be towards the branded product. I think many of you know I grew up in one of the branded hotel companies, so I guess I was taught a lot about that over the years. And having said that, an unbranded product would not be out of the question in the right set of circumstances. We're typically pretty disciplined about how we invest, though, so we don't typically invest in the operator side, so we tend to focus just on the real estate, and we prefer the management contract model. Although we've done leases, we prefer the management contract model. So typically on the upper upscale luxury end, we go with the branded operators, because the brand gives you a lot of things, not just revenue driving. I mean, that's a big part of it, but it give you a lot of other things as well that we find valuable. We have one transaction, one platform in the U.S., actually 2 platforms in the U.S. that are more select service oriented, where most of it's branded, but on the franchise model, and the manager's independent. But we don't operate ourselves, which is always an interesting challenge when you go unbranded, is who is your operator. So.
Mm-hmm. How about you, Chris? Will you ever consider an unbranded situation?
Yes, absolutely. I mean, certainly having a brand, it's an important part of the value proposition, but you know, just going to the real estate, you know, there's times when a brand can add tremendous value, and then there's times when perhaps the asset is better unbranded. You know, we're also looking at it not only as an investor, an asset manager, but we're also looking at it from an operator's perspective, because we have 2 soft brands where we operate hotels ourselves, between Birkenstock Selection and Merweb. I think that we'd like to do more hotels that we operate on our own. But you know, obviously, when we're working with the brands, you know, we'd like to see what they bring to the table.
And how do you deal with the issue that most hoteliers are having to wrestle with, which is the strong emergence of the OTAs as being a challenge to the branding message, as being saying to an owner, look, you can get your hotel filled just by dealing with us. You don't actually need the brand to be able to do that. So what is your views on where the OTA needle is heading, and how are the brands actually dealing with that particular issue?
Well, I mean, I think the OTAs, it's a great learning tool for the industry. Unfortunately, the hospitality industry is not known for innovation, and often we take our cues from other industries, other sectors. So in a way, the OTAs have come in and beat the brands at their own game, because the brands, the whole, you know, not the whole proposition, but a very important element of that is, you know, the brands are supposed to deliver business to your hotel. Well, now that's in some effect been offloaded to the OTA. So I think the challenge of the industry is to figure out how to get that back, because it's more expensive. The OTAs are more expensive to get that business.
So, Mike, are you looking to the brands to reduce their fees to you because they're not doing the entire job?
Yes.
So,
No, I think
so
that,
where have you been successful in doing that?
Nowhere.
You wish.
Look, I mean, the OTAs, they're here to stay, and I think what we need to figure out is a way to work with them, and the brands need to find a way to work with them. But a lot of it is about, just discipline in pricing and how the brands manage, their pricing models so that it works with the OTAs. But they are here to stay, and we're going to have to learn to live with them. So it's just another, it's another market segment. In the U.S., I guess Airbnb's made its way here too a bit, but in the U.S. we're seeing huge inroads from Airbnb, which is just another sort of
another way of getting rid of your rooms.
Yeah, and it brings actually new competition to the market as well. It's just all these things we have to deal with, and I think you're right. I think the brands have to continue to show that they're worth what they charge in terms of being able to continue to earn the business from investors like us.
Just as a slight aside, Derek, do OTAs have a major impact in the business in China?
Actually, the hotels there are paying more attention to OTA as well. I would say although relatively, as far as I can see, relatively in terms of the reliance on OTA is not that high, but it's increasing. So relatively, I would say compared to the traditional business strategy. And for us, for as a REIT, I would say that for us it's not as important, that because if we are landlord, the more important thing is they pay us rent, and then what we are doing is that we stand.
How it's earned, you really don't mind. Yeah, I think we got the message there. I'm starting to run out of time because we were asked to wrap up slightly early. But fortunately, gentlemen, there's a young man about 4 rows from the end in the middle block. If we can get a microphone to him, please tell us who you are and what your question is. Thank you.
I'm Pedro Petiz from Abington Financial in London. 2 questions for Derek and then one for all the speakers. Derek, at what point of the cycle do you see or do you believe we are in of Asian capital deployments in Europe, in UK? And second question, I thought it was very insightful that you mentioned that yields back in your home markets are reaching 3%. And do you feel that yields could reach those kind of levels, and that would be the sort of breaking point of Asian capital deployment in these markets? And then a third question for the panel.
Hang on, hold the third question. Even I can't remember the first 2 now. Derek, take the first 2 questions. Do you remember what they were?
So real estate cycle, right? I would say the real estate cycle, if I look at the real estate cycle, not just look at hotel, because I came from a real estate instead of hotel background. I would say that in general, if you look at the real estate cycle, the thing is that look at the maybe the past 2 decades, the best timing of getting out of Asia before Asian crisis was actually a best timing to come to the Western world. And the best timing of getting out of Western world, going back to Europe or US, from the Western world to Asia was actually the best timing to Asia. The best timing of getting out of Asia, Europe and US was actually the best timing of getting into Asia last time. So right now I would say that the thing is. Although no one can guess at what point would be the peak of the cycle, but the thing is that obviously if you look at the risk relative risk kind of control perspective, Asia definitely is much higher risk than the Western world from my perspective, looking at the real estate cycle. And one of the reasons why although it so happened like this, but the thing is I try to rationalize the cycle behavior is in the sense that it's all from my perspective driven by liquidity all along. So this time around, we are seeing liquidity coming from Asia to US and Europe, and that is actually driving the recovery in, let's say, in Spain real estate market. And I just went to the conference set up by Spain consulate, and then their property markets, you probably know more than I do, is coming back up already, probably because of the liquidity coming from Asia, coming from the rest of the world. So. So going to your second question, in terms of the yield, I would say that for Asian to come to Europe to buy real estate is not just about yield. What yield is one consideration. Let's say, for example, just now I forgot to to mention that is in the sense that although we have been seeing a real estate price in Europe has gone up a lot already, But from Asian perspective, we look at our currency US versus the, the depreciation in euro, all these things. Actually, if you look at the past 3 years, basically it's breaking even or something. So from our perspective, we don't think it's much more expensive to buy now because of the currency depreciation. So whether at what point in time we are seeing this kind of liquidity flow come to an end, I would say that, probably by the time when, I don't know, we are seeing the burst, I would say, in the Asian real estate market, but, who knows. And from my perspective, one of the possible driver for Asian market to start to show, a more significant, kind of correction would be the US, is driven by US, because every time when you see US dollar strengthening, US interest rate going up, the liquidity in the Asia, start to leave. So that would drive, because if no liquidity, that means the real estate market will not be supported. So
Okay.
that's one thing.
Okay. You had a third question to ask for the whole panel, yeah?
Yes, Derek actually just brought it up. I just wanted to ask how your three institutions would look at central bank policy, and obviously the devaluation, particularly in the euro, that has been seen over the last few months, and now that impacts your approach, given your longer-term view for your company's investments.
Okay, thanks. Chris, do you want to kick us off on that?
I mean, for us, I think, it's something that we keep a look at, but I'm not sure that it has any bearing on our long-term investment decisions.
Yeah.
Yeah, same. I think it's just a question of, I think I said before, it's a question of what the impact is on asset pricing. There's no question that quantitative easing in the U.S. drove up asset prices. I think everybody accepts that. Now, what isn't clear yet is what's going to happen to all this money that the ECB is putting into the market. Where is it going to go? It doesn't necessarily stay in Europe, because money can flow anywhere. It can go elsewhere, but it will have an effect somewhere.
Well, thank you for your question. Really appreciate it. We've got to the end of our session, but I've got one question that I'd like our panelists to answer each in a fairly short way, if you don't mind. I'd like you to give one single piece of advice to other investors from your respective regions, other than leave it to me, which obviously isn't an option. What single piece of advice do you have for them when considering investing in hotels in Europe? What's the one piece of advice that you have from what you've learned, Derek, Mike, Chris?
I would say that, I used to be a fund manager. The thing is, compared to the past, right now to be a fund manager is much more difficult to forecast. Basically, you can't forecast because the whole world is driven completely, substantially by the government policy. So in this kind of environment, risk control is very important. So, that's the reason, we also adopt a more conservative approach, in going into whatever market. So this is my advice.
Okay, Mike?
Probably applies everywhere, but I would just say that leverage doesn't change the value of anything. It just changes the price you can pay.
Yep.
That was good, wasn't it?
It was good.
Yeah, that was
I
very
stole
good.
what he said.
You stole
That's not
that.
mine. I stole that from a friend.
Have a very well-defined strategy for your asset, and then plan B, C, and D.
The one thing that I said when we met to discuss this session earlier today was that let's remember, this industry is noted for having a 10-year cycle and a 5-year memory. And with that, ladies and gentlemen, please thank our panel.